Well, hey guys, welcome welcome back to the Animal Donut channel. My name is Jeff. If you've been here before, fantastic. Take a seat, stay a while. If you haven't, take a seat, stay a while, because today we are going to talk about Amazon. Now, specifically, I want to talk with you about how I came to invest in this stock and what I saw in it. And the thing you should know is that, sure, now everybody knows that Amazon's a great company, it's solid, it's strong, but when I invested in it several years back, it was not a foregone conclusion that this was a smart investment or that the stock wasn't insanely overpriced. Now, think about this. It's over $3,000 a share today, right? Seems really expensive. Well, in 2015, when I first seriously thought about buying Amazon stock, it was less than $1,000 a share. In fact, I'm going to show you, this is a piece of foam core, and I have about 5 companies listed, and one of them right here is Amazon, and it says July 30th, 2015, and it has the stock price of $536.15. So yes, I was thinking about investing in this company back in July of 2015. Now, I didn't invest at that time right away. I thought about it, but one thing you have to keep in mind is that that company seemed really expensive at $536 and change. And you might say, comparing it to today's price, which is well over $3,000, you might say, well, it was really cheap. But then you had to realize that we were looking in the rearview mirror, and Amazon stock just a year or two earlier was in the $200 range, and before that it was in the $100 range, and before that, it was much cheaper. So at any time for any investor, when you're looking at a stock price, it can be a little bit difficult to make a decision because we're constantly looking in the rearview mirror at what the price was, but we can't really project where the stock price is going. And that's also one of the problems with investing, is that it's easy to get fixated on the stock price because that's obviously what you wind up paying when you want to buy shares. But the stock price doesn't really tell you anything. So it's not the place to start. What I want to share with you is a few details about Amazon. Now, obviously, it's a very simple business to understand. You don't have to know a whole lot about technology or about healthcare or medicine or about semiconductors to understand how Amazon works. It's a powerful business and it's very efficient. Now, as simple as Amazon is, they're also unlike any other company that I know, because even though it's one company, it's really 2 businesses under this umbrella of Amazon.com. One of the businesses everybody knows about, and that is their internet retailing. So you go onto their website and you can buy stuff from them. But the tech business, AWS, which stands for Amazon Web Services, is much more profitable than their retailing business. The margins when you sell things online are much smaller. They can be 1%, 2%, 3%, 4%. Usually when you're selling things online, the amount of profit margin is much smaller than what you can earn as a tech company. Their margins for their technology business, AWS, is above 25, 30%, 35%. And so when you compare those two, it's just phenomenal to see the power of AWS. I've heard somebody who works there say that all of us, meaning all the people who work at Amazon, are surfing on the couch of AWS. AWS definitely raises the most money and is the most profitable part of the company. And they subsidize all of the other experimentation, all of the other growth of businesses, and they pull in the big bucks for Amazon. Streaming media services like Disney, like ESPN, or Netflix, or even, I just was doing some research on Adobe. The Adobe Creative Cloud and the Adobe Experience Cloud, whenever you download software from Adobe, you're actually using software that is hosted on Amazon Web Services. So many of these companies are using AWS as their backbone. So many other companies depend on them for their cloud computing infrastructure. And so they've just made themselves kind of indispensable. I think I was at a Starbucks and I think I heard somebody say like, oh, I'm thinking of buying this or something. And somebody said, oh, you should get it at Amazon. And then I think I was looking and there was somebody next to me and they were buying stuff on their laptop on Amazon. And I just started realizing like, whoa, this is part of everybody's daily conversation, whether you're aware of it or not. Either you or someone in your friend group or your family needs something and is buying something, and their first choice when it comes to convenience, when they don't have the time to like get in the car and drive a half hour to Costco or Walmart or Target or whatever, is to buy it on Amazon and have it delivered. And so this convenience is incredible. And by offering Prime, you have all of these customers who immediately become loyal customers to Amazon, because once they have paid the $130 or whatever the Prime membership costs at the time, they feel like, hey, I've got to take advantage of this. I got to use it. And it also just provides so many conveniences as far as Amazon streaming through Amazon Prime and through their music software and all these other things that you kind of get when you sign up for Prime. So it's a very sticky business, meaning once you start using it to watch, streaming movies off of Amazon, once you start ordering stuff, once you start using Amazon Alexa, you start realizing like, oh, this is really cool and I wouldn't want to give it up. So even though this video is about Amazon, I just want to share with people who are watching it that it's not really hard to find businesses like Amazon. And you don't always have to find the business when it's brand new and nobody knows about it and it's really cheap. I mean, of course, that's the dream, is to find some amazing company and buy shares in it when it's cheap and nobody else knows about it. But this is like finding the needle in the haystack. And whenever companies are that new and that innovative and that kind of unproven, it's really risky, because you don't know whether their technology or their business model is going to survive. So I think that's much more of a gamble. But there are businesses out there that have already started to prove themselves. Now, buying Amazon in 2002 or 2005 or 8 or 10, there seemed to be a lot more uncertainty among some investors, not all, but some, as to whether Amazon's business would really gain traction and be durable and be profitable. But somewhere around 2015, 2016, they started showing a profit, meaning they've always reinvested a lot of the money that they make, the profits they make, back into the business. But around 2015, they started to, in addition to reinvesting into their businesses, they started to show a profit in their income statement. And so even though that was relatively late for investors who wanted to get in early with Amazon, you could still buy the shares of the stock in the $500 range, or like me, you could have waited, and even though you dawdled when you could have dove in earlier, you could still buy the stock for about $1,000 a share. So even though you might not have been one of the early investors in Amazon, you could still buy the stock at a price that made sense and that one could justify based on the amount of new and growing subscribers to Amazon Prime and to a lot of the new products that were available through them, like Alexa, and the innovation that they were driving with Amazon Web Services. So just by paying attention, by being patient, you didn't have to dive in and buy a stock early days when there was uncertainty. Even at 2015, 2016, 2017, you could still buy Amazon at a relatively inexpensive price compared to the growth and a lot of the progress that the company was making. So my point here is not too hard to find businesses like this, but you need to be patient and you need to be perceptive to what's going on around you. Here are a few examples of companies that I did not invest in right away, but I thought about and I gained some experience. Costco is a company that, even 3 or 4 years ago I hadn't invested in, but it became obvious to me that so many of my friends, so many people in my neighborhood go to Costco every week, every couple of weeks, they stock up, they buy a lot of stuff. And when it comes to buying, food, electrical equipment, stuff for their family, clothing, they go to Costco to stock up. And so this to me just seemed like a really obvious, solid investing idea. Apple is another one that just seems kind of like a no-brainer. Obviously, in the current economy, everybody is gravitated toward a real solid company that's incredibly profitable and probably the most successful company on earth, Apple. But there are times when in the future there are going to be companies just as good as Costco, Apple, CarMax is another one, Nvidia or Adobe that are out there, and at certain times their stocks can become really inexpensive relative to the growth and the success of the business. So you just need to be open and aware. And this is 4 or 5 companies I've listed. There are hundreds of companies out there, and I think as an investor we don't need to focus on every company. We just need to stick to those where we are capable of understanding them just based on our education, where we work, our experiences as customers. And it's not magic, but it requires being patient and doing a lot of reading, watching videos, talking to people, and becoming an expert in these different businesses to the best of your ability. So whenever I'm thinking of buying a stock, I like to make sure that it passes the 5 steps of the Palms filtering system. Now this is a system that I thought up on my own, so you're not going to read about it in other places or see it in other videos, but this works for me. I want to share it with you because whenever you're thinking about investing in a stock, you can just run through these 5 steps on your own and you can figure out whether this makes sense for you as an investment. So the first thing is the company has to be profitable, and you can read the income statement. You can look at the financial statements in the annual report for the company, and you can find out whether the company operates at a profit. There are thousands of businesses out there with stocks, and the companies are actually not making any money. They're losing money. But they make these projections of profits into the future, and they have big plans, and they get a lot of hype and a lot of excitement from people in the marketplace, but they're not actually profitable. So I confine myself only to those businesses that have proven that they can actually survive without any external money coming in to keep them afloat. Profitable. Apex. Are they an apex predator? Are they at the top of the food chain and a very powerful force to be reckoned with? L. Is the company loyal customer? Do they have loyal customers? For example, Costco has people who every week or two, like I said, they come back and stock up. Apple, when people have an iPhone and that iPhone breaks or gets lost or it's time to be upgraded, they don't go looking for other phones to buy. They want to get the next iPhone. That is really powerful customer loyalty. And when you think about Starbucks, people come back to Starbucks again and again. They go there, it's part of their weekly routine. Maybe they go there before work or after work or during lunch, but people are very loyal to Starbucks. For creative people, graphic designers, photographers, they use Adobe products. They use Photoshop, Lightroom, Premiere. But they don't go looking for some other off-brand photo editing software, for example. They just want to go with the best, and that breeds a kind of customer loyalty that Adobe has with Photoshop. M, moat. Is there a durable competitive advantage that this company has? Something that makes them resistant to competition. Think about it. All great companies that have, for example, Nvidia, they make the best GPUs, graphic processing units. There are other companies that make them, but when it comes to being the top of the whole industry sector, it's Nvidia. So I like companies that have very durable, strong, anti-competitive, resistant to competition moats. And finally, no stock is worth an infinite price. So the price has to be sensible, taking into account the vicissitudes of life and the volatility in markets. So you don't want to overpay. You don't want to buy a stock when it's at its all-time high and it's been going up for weeks and months and years. So you want to look for a time when something happens in the economy or a temporary setback in the business and the price will drop 10%, 15, 20, 30%. It happens all the time. So anyways, there you go. There's the Ponds filtering system, and I hope that you'll find it useful. Give it a try. I think you'll find that it gives you kind of a framework to think about investing. It's a real simple filter, and you can use it anytime you're thinking of investing in a stock. I hope you liked our little rundown of Amazon. If you like this video, please click the like button. And also, if there's some other company that you'd like to learn about in the future, put a little comment in the section below. Just write down the name of the company that you're interested in, and I will strongly consider making a video about it to provide my best insights and ideas and help you to study the company. And if you haven't already, please consider subscribing to the channel, tap the little bell icon, and then you will get notifications every time I make a new video. I'm real glad you stopped by, and I look forward to seeing you in the next video.